In the world of investing, the vast majority of people hold a deeply ingrained belief. The more capital one has, the greater the investment risk one can bear. This notion is not only widespread among ordinary investors, but has also become a central premise of many wealth competition TV shows, as if there were an inherent positive correlation between the size of one's wealth and one's risk tolerance, as if possessing greater wealth necessitated taking on higher risks to match one's financial stature. However, few people realize that once one officially enters retirement, this widely accepted rule undergoes a complete reversal. This has been repeatedly confirmed by various authoritative studies and is also a valuable lesson drawn from the practical financial management experiences of many high net worth retirees. When your investment portfolio reaches a certain size, you will gradually discover that you no longer need to rely on market fluctuations to sustain your lifestyle in your later years. In fact, globally renowned financial research institutions, including Morningstar, as well as leading researchers specializing in retirement finance, have drawn a key conclusion through decades of research and analysis. The higher a retiree's wealth level, the lower the investment risk they actually need to bear. In fact, they may even proactively choose to reduce their risk exposure, no longer blindly pursuing excessively high investment returns, but instead prioritizing the safety of their wealth. The core logic behind this is closely tied to the shift in core needs during retirement, a topic we will explore in depth next. To understand this seemingly counterintuitive phenomenon, we must first clarify a fundamental principle. Your entire financial situation after retirement can be distilled into a remarkably simple equation: the total value of your investment portfolio divided by your annual living expenses. This ratio is frequently cited in retirement planning research and is commonly referred to in the industry as the funding ratio. This seemingly simple figure can explain nearly all investment risk-related decisions during retirement, because as this ratio increases, your financial strategy and risk tolerance undergo a fundamental shift, moving from pursuing wealth growth to preserving existing wealth. First, we need to correct a common misconception. Retirees do not consume their assets according to a fixed percentage of their investment portfolio. All retirement finance studies we've reviewed clearly indicate that actual spending patterns do not follow this model. Retirees' expenses dynamically change over time due to the length of retirement, shifts in health, and adjustments to lifestyle needs. In fact, specialized research, including studies by David Blanchot and data from Morningstar, shows that approximately 75% of retirees see their spending gradually decrease as they age. From the early to mid-retirement years, after accounting for inflation, annual real spending decreases by about 2 percentage points. This downward trend becomes more pronounced in the later stages of retirement, particularly as retirees age and their mobility decreases, leading to further reductions in spending needs. This phenomenon warrants our close attention, as understanding the true patterns of post-retirement spending can help us set more reasonable goals for our retirement investment portfolios and avoid unnecessary investment risks stemming from overestimating consumption needs. This downward trend in spending is particularly pronounced among affluent retirees. Their actual spending often falls far short of what they could afford. And for many high net worth retirees, annual consumption accounts for only 1% to 2% of their total investment portfolio. Researchers have dubbed this phenomenon the retirement consumption gap. Simply put, even when retirees have sufficient funds to significantly improve their quality of life, or even easily afford global travel and high-end retirement living, many choose to exercise restraint in their spending and do not squander their accumulated wealth. This spending habit further reduces their reliance on investment returns. We can better understand this pattern through concrete figures. Suppose a retiree holds a $1 million investment portfolio. Based on a standard of living, they might need to withdraw 4% to 5% of this portfolio annually. That is $40,000 to $50,000 to cover daily expenses, healthcare costs, and anticipated lifestyle needs, such as occasional travel or gatherings with family and friends. However, if a retiree's investment portfolio reaches $5 million, they would only need to withdraw 2% to 3% of the funds annually. That is $100,000 to $150,000 to maintain the same or even a higher quality of life. This would not only cover all daily expenses, but also set aside funds to address unexpected medical costs and enjoy high-end retirement services. Clearly, as wealth continues to accumulate, the required withdrawal rate for gradually decreases. This is the first key cornerstone for understanding the logic of retirement investment risk. Moreover, from an intuitive perspective, this makes perfect sense. After all, the more wealth one has, the greater the confidence in meeting life's needs, eliminating the need to rely on high-risk investments to bridge funding gaps. Many people who accumulate substantial wealth often have long-standing good habits. Working hard, living disciplined lives, and spending wisely. Even when their wealth reaches a certain level, they do not readily alter their established lifestyle. Even though $5 million is a massive fortune in anyone's eyes, enough to sustain a life of luxury, many retirees with this level of wealth still maintain the lifestyle of an everyday millionaire. Their lives appear not much different from those of ordinary people. Their daily expenses are relatively moderate, and they do not blindly purchase luxury goods or pursue excessive consumption. Compared to their massive investment portfolios, these daily expenses are almost negligible. This rational approach to life not only allows them to accumulate substantial wealth, but also enables them to handle financial matters with greater ease in retirement, without having to take on excessive investment risks. Based on this premise, let's examine Morningstar's latest study on withdrawal rates, which clearly indicates that for a well-balanced portfolio, a withdrawal rate of approximately 37% to 39% is generally considered a sustainable level, capable of supporting a retirement lifestyle for over 30 years. However, it is important to note that this standard is designed for the typical retiree, that is, those whose wealth just covers their retirement needs, without excess reserves, and does not apply to high net worth retirees whose wealth far exceeds their retirement requirements. This is because once your withdrawal rate drops to the 2% to 3% range, the likelihood of depleting your retirement funds decreases significantly to the point of being negligible. For many high net worth households, their investment portfolios not only easily support their retirement lifestyle, but often result in a surplus relative to their lifestyle. Even in the event of significant market volatility, their basic quality of life remains unaffected. Simply put, the higher your capital ratio, the greater the probability of a successful retirement financial plan. Once you reach a very high capital level, such as an investment portfolio exceeding $5 million, the risk of investment failure or depletion not only drops sharply, in many cases approaches zero. This is precisely what many people struggle to grasp intuitively. We have long been influenced by the notion that more money means greater capacity to take risks. Yet we overlook the fact that core needs during retirement have undergone a fundamental shift from accumulating wealth to preserving wealth, and from relying on the market to detaching from the market. This shift in needs directly dictates adjustments to investment risk preferences. Let's consider a concrete example. Suppose you hold a $1 million investment portfolio, live an upper middle class lifestyle, own a fully paid off home, and both you and your spouse have paid off your cars in full, with no debt pressure whatsoever. On the surface, it might seem you have ample confidence to adopt a relatively aggressive investment strategy, such as allocating the majority of your funds to the stock market to pursue higher returns. However, research on retirement planning tells us the opposite is true. The more wealth you have, the less need there is to take on excessive risk. From an academic perspective, studies on optimal portfolio structure indicate that when a household's wealth exceeds the level required to sustain retirement, the optimal allocation to high-risk assets decreases accordingly. Put simply, once you've won the retirement race, that is, accumulated enough wealth to support a lifetime of retirement, there's simply no need to maintain an aggressive investment strategy and take on unnecessary risks. To fully grasp this, we need to distinguish between two easily confused concepts: risk tolerance and risk capacity. Although these two concepts appear similar on the surface, they are fundamentally different and have a crucial impact on investment decisions during retirement. Many retirees fall into financial pitfalls precisely because they confuse these two concepts. Risk appetite refers to the level of investment risk you are subjectively willing to take on, which is typically related to personality, investment experience, and psychological state. Some people are naturally adventurous and are willing to invest in high-risk assets even after retirement to pursue higher returns. Whereas risk tolerance refers to the amount of risk you can objectively bear without jeopardizing your established retirement plan. This is closely related to your wealth level, consumption needs, and income sources, and represents a relatively objective figure. As wealth grows, we often find that a person's risk appetite is actually quite resistant to change. Some people are naturally inclined to take risks, while others are naturally conservative. These subjective tendencies do not shift significantly with increasing wealth. For example, some retirees, even with investment portfolios worth millions of dollars, still prefer to invest in high-risk assets such as stocks and futures, while others, even with modest wealth, insist on keeping their funds in banks or purchasing lower-risk products like government bonds. Interestingly, however, risk tolerance does change significantly with shifts in wealth levels. The lower the wealth level, the more pronounced this change becomes. Conversely, the higher the wealth level, the greater the flexibility and risk tolerance, and the less need there is to take on high risks. When you are just beginning your personal financial journey, such as when you first enter the workforce with limited savings, you need to adopt a fairly aggressive investment strategy. This is because you need your funds to grow through compound interest over the long term. In order to gradually accumulate sufficient wealth and ultimately achieve financial independence and your retirement goals. At this stage, your ultimate success depends largely on the market's long-term performance. If your investments are too conservative and your capital grows too slowly, you may never accumulate enough retirement assets or even fail to retire on schedule, forcing you to extend your working years. This is why many young people choose high-risk, high-return assets when investing. They have enough time to weather market fluctuations and the resilience to recover from investment losses. The text explains that reaching significant wealth changes investment priorities, shifting the focus from market-dependent gains to the protection of assets, as volatility now poses a greater threat to long-term security. Using the example of a $5 million portfolio, the passage illustrates how conservative returns can easily exceed typical retirement spending, allowing wealth to grow steadily through the power of compound interest. By comparing different wealth levels, the narrative highlights the relationship between portfolio size and withdrawal rates, noting that smaller accounts often face higher risks that exceed conventional safety margins. About a risk. At this point, the risk of investment failure is very real. No planning model can guarantee that a 6% withdrawal rate can be sustained long-term without depleting funds, especially during market downturns or investment losses when the risk of running out of money increases significantly. In this scenario, if you wish to maintain a 6% withdrawal rate, counteract the effects of inflation, and ensure your quality of life does not decline, you must adopt a flexible investment strategy, constantly monitor market trends, and make corresponding adjustments. For example, when the market is rising, you should appropriately increase your allocation to high-risk assets to achieve higher returns. When the market is falling, you should promptly reduce your allocation to high-risk assets to minimize losses. This is because the risks at this stage are already very significant. You have entered the potential failure zone, where you must contend with multiple risks, including the risk of reverse order of returns, longevity risk, and inflation risk. This implies that your investment portfolio must prioritize growth, requiring a higher allocation to equity assets such as stocks and mutual funds. meaning you will become more reliant on market performance. For retirees at this stage, favorable market conditions are not merely an optional bonus, but a prerequisite for the success of their retirement plan. Should the market experience a prolonged downturn resulting in substantial portfolio losses, they may face the risk of depleting their funds, which would negatively impact their quality of life in retirement. Next, consider retirees holding a $3 million investment portfolio. This is precisely the stage where we begin to see a shift in risk perception, which we can refer to as the balance zone. Assuming their annual expected expenditure is $90,000, their withdrawal rate is only 3%, far below the conventional safe withdrawal rate, placing them in a relatively safe zone. At this point, the withdrawal rate drops significantly, and the stability of the investment portfolio improves accordingly. An annual income of $90,000 carries far less risk than in the case of a $1 million portfolio. Even if faced with short-term market volatility, it will not affect their basic quality of life. Historical data shows that no historical scenario indicates that a 3% withdrawal rate paired with a well-balanced US investment portfolio would result in depletion of funds. Whether during economic crises of the last century or recent market volatility, a well-balanced portfolio has consistently delivered relatively stable returns, sufficient to sustain a 3% withdrawal rate. This provides retirees with immense confidence, a confidence that retirees holding a $1 million portfolio with a 6% withdrawal rate simply cannot possess. At this stage, you no longer walk a tightrope, constantly worrying about running out of funds. Instead, you'll feel you have more breathing room. There's no need for excessive anxiety. Even if your portfolio experiences short-term losses, you'll have sufficient reserves to weather them without affecting your daily expenses. Of course, favorable market conditions and portfolio growth remain desirable, as sustained wealth growth can further enhance the quality of your retirement and leave a larger legacy for future generations. However, you are no longer as dependent on the market as before. Market fluctuations will no longer directly impact your retirement plan. Therefore, retirees at this stage typically opt for a more balanced portfolio that balances asset growth with stability. For example, allocating 50% of funds to equity assets and 50% to low-risk assets such as bonds and cash. This approach allows them to generate reasonable investment returns while effectively mitigating the risks associated with market volatility. At the same time, they shift their priorities toward income, reliability, tax efficiency, optimization, and more strategic management to fund withdrawals. This includes planning annual withdrawal amounts reasonably to avoid undermining the compound growth of the portfolio through excessive withdrawals and reducing unnecessary tax expenses through sound tax planning to further enhance the portfolio's ability to preserve and grow wealth. Retirees with a $3 million investment portfolio will, of course, still care about market returns and hope for continuing asset growth. But this concern is no longer a necessity, but rather a nice to have, because at this stage, your retirement plan already has an extremely high probability of success. Even if the market performs poorly, it will not affect your basic quality of life. More importantly, once the withdrawal rate drops to around 3%, even with a balanced portfolio, your assets are likely to grow faster than the rate of withdrawal. In other words, the total value of your portfolio will continue to increase during retirement, further enhancing the security and stability of your retirement lifestyle. For example, assuming the portfolio's annualized return is 4% and the withdrawal rate is 3%, the annual asset growth rate would be 1%. Over the long term, the total value of the portfolio will continue to increase, the retiree's wealth will grow, and their ability to handle unexpected situations will strengthen, eliminating the need for excessive worry about funds. Finally, let's consider a retiree with a $5 million portfolio. This is the low-risk zone we're focusing on. In this scenario, their withdrawal rate might be as low as 2% and would not exceed 2.5% at most. This means that withdrawing just $100,000 to $125,000 annually from the portfolio would be sufficient to cover all daily expenses and additional needs, such as high-end medical care, global travel, and gifts for family and friends. With such a large and stable investment portfolio, combined with an extremely low withdrawal rate, they can still generate a substantial annual income, approximately $100,000 to $120,000, enough to enjoy a high-quality retirement without worrying about any financial issues. At this stage, the portfolio is no longer merely sustainable. In fact, relative to their lifestyle, their funds are in a state of significant surplus. When the withdrawal rate approaches 2%, the risk of depleting funds is virtually zero, regardless of how your portfolio is allocated. Even if all funds are invested in low-risk assets like bonds and cash, it can easily sustain a lifetime of retirement. This means that when an extremely modest withdrawal amount is sufficient to support your retirement plan, your portfolio is likely to continue growing through compound interest at a rate far exceeding the withdrawal rate. Wealth will continue to accumulate and may even double during retirement. For these retirees, investing is no longer about generating income to support daily living, but rather about preserving wealth, avoiding depreciation caused by inflation, and leaving a larger inheritance for future generations. At this stage, investment returns are no longer the primary driver of financial planning. We observe a significant decline in retirees' risk tolerance, a trend supported by extensive research. When household wealth exceeds the level required to sustain retirement, the optimal allocation to high-risk assets actually decreases. This is because, at this stage, you have already won the retirement race. There is no longer a need to take unnecessary risks in pursuit of higher returns. Safeguarding existing wealth is the core priority. After all, any high-risk investment carries the possibility of loss, and should a loss occur, it would undermine the wealth you have accumulated, making the risk not worth the reward. It is important to emphasize that all of our analysis here is based on very conservative assumptions. We have only considered conservative income from investment portfolios and have not factored in other potential income sources for retirees, such as Social Security benefits, pensions, or income from part-time work. In reality, many retirees have multiple income streams, especially high net worth retirees. In addition to investment portfolio returns, they may also receive rental income, pensions, and Social Security benefits. These sources further bolster their financial buffers, making their financial situation more robust. The surplus of funds becomes even more pronounced, reducing the need for high-risk investments and enhancing the security of their retirement. For example, a retiree with a $5 million investment portfolio might also receive $50,000 in annual pension payments and $30,000 in rental income. As a result, their total annual income would reach $180,000 to $200,000, leading to a further reduction in their withdrawal rate and a corresponding decrease in their appetite for risk. It is precisely for this reason that retirees' financial goals undergo a fundamental shift from the previous focus on maximizing investment returns to protecting existing wealth. When your wealth is still modest, you do need to prioritize investment returns, as you constantly worry whether your portfolio can support your lifestyle for the next 10, 20, or even 30 years, whether it can continue to provide a stable income, and whether it can handle unexpected medical expenses or unforeseen events. However, once your portfolio reaches a certain size, you'll clearly realize that, no matter how the market fluctuates, it can easily support your retirement lifestyle and even leave an inheritance for future generations. At this point, your core need becomes protecting this wealth, rather than continuing to take risks in pursuit of higher returns. After all, excessively high returns often come with excessively higher risks, and any losses could undermine the achievements you've accumulated over many years. From a holistic perspective, we can clearly observe a curve of risk evolution. When holding a $1 million investment portfolio, you must actively engage with the market and assume higher risks to ensure the success of your retirement plan. Market fluctuations directly determine the quality of your retirement life. With a $3 million portfolio, you need to strike a balance between risk and stability, no longer relying excessively on market performance. The impact of market volatility on you will decrease significantly, and the success rate of your retirement plan will improve markedly. And with a $5 million portfolio, you hardly need to take on any risk at all. Even with a low-risk investment strategy, you can enjoy a stable and worry-free retirement. Market fluctuations will have a negligible impact on you, allowing you to completely break free from the constraints of the market and enjoy your retirement with peace of mind. This has nothing to do with personal temperament or whether you are aggressive or conservative by nature. It relates solely to your degree of reliance on market returns. Research on retirement planning consistently demonstrates that the importance of risk diminishes as wealth increases. More wealth means less risk. Once you understand this shift, investment portfolio decisions during retirement become clear and rational. You will no longer fall into the trap of blind risk-taking, nor will you compromise wealth preservation and growth due to excessive conservatism. The reason many high-net-worth retirees are able to enjoy a comfortable retirement is precisely because they shifted their financial mindset in a timely manner, prioritizing the safety of their wealth and avoiding unnecessary risks. In practice, we can observe this pattern. Affluent retirees often increase their allocation to bonds and cash-equivalent assets to establish a stable income floor, prioritizing asset stability over growth. They no longer blindly pursue high returns from equity assets like stocks, but instead opt for more conservative investment strategies such as purchasing government bonds, corporate bonds, and larger denomination time deposits. Although these assets offer lower yields, they carry extremely low risk, ensuring the safety and stability of funds. Morningstar research even explicitly indicates that for many retirees, limiting the allocation of equity assets to between 20% and 40% is the most reasonable choice, especially when their demand for investment returns is low. This allocation maximizes asset safety while still generating a certain level of return, thereby preserving and growing wealth. Why is this the case? Because lower asset volatility significantly enhances income stability, thereby substantially reducing the risk of drawdown, a factor that is particularly critical during retirement. Drawdown risk refers to the scenario where a market downturn occurs early in retirement, causing significant losses in the investment portfolio. If you need to withdraw funds to cover living expenses at this time, it further exacerbates the losses, ultimately leading to the risk of depleting your funds. For retirees, investment performance during the early years of retirement directly determines the success of their retirement plan. Therefore, reducing asset volatility and ensuring income stability can effectively mitigate this risk. After all, if you do not need to rely on high-risk investments to achieve higher returns, why take the risk of asset losses to pursue those unnecessary gains? Rather than assuming additional risks, it is better to securely preserve existing wealth and ensure a stable and comfortable retirement. This is the core objective of retirement financial planning. Of course, we must not overlook the influence of behavioral psychology. Data alone cannot fully determine a retiree's investment choices, as personal finance is ultimately a personal matter, and individual factors will always come into play. Everyone's personality, investment, experience, lifestyle needs, and family circumstances differ, so investment portfolio allocations will naturally vary. Yet we can still observe a consistent pattern. Retirees with highly conservative portfolios and withdrawal rates below 2% often see their portfolios grow steadily throughout their retirement and may leave behind substantial untouched wealth upon their passing, creating a valuable legacy. Most of these retirees have rational spending habits and conservative investment preferences. They consistently prioritize the safety of their wealth, avoiding reckless risks and excessive consumption. This behavior is fully consistent with the principles we mentioned earlier: reducing expenses, minimizing risk exposure and focusing on long-term wealth preservation. However, it is worth noting that even affluent retirees have their own concerns. They worry that high healthcare costs will deplete their wealth, especially in old age, when they may face serious illnesses requiring substantial medical expenses. They fear outliving their funds, given that life expectancy is increasing and retirement may last 30 years or longer, and they are concerned about leaving insufficient inheritance for their families, hoping to provide some financial support to their children and grandchildren. It is precisely these concerns that lead them to further cut back on daily expenses and reduce investment risks, ultimately resulting in many people failing to fully utilize the wealth they have painstakingly accumulated over their lifetimes. This has become a new challenge for many high net worth retirees: how to strike a balance between preserving wealth and enjoying life. In fact, this mindset is not hard to understand. Many millionaires, even with substantial assets, still do not consider themselves rich. This psychological perception often directly influences their spending and investment decisions. Behind this lie, concerns about future uncertainty, long-established habits of rational spending, and an obsession with accumulating wealth. This psychological phenomenon further explains why affluent retirees tend to favor conservative investments and restrained spending, always prioritizing the safety of their wealth. Having experienced the hardships of wealth accumulation, they know that every penny is hard-earned. Thus, they are unwilling to take risks lightly or spend frivolously. While this mindset safeguards their wealth, it may also cause them to miss out on opportunities to enjoy life. In summary, we can draw a clear conclusion. During the years when you are working and accumulating wealth, the notion that the more wealth you have, the higher your risk tolerance may hold true, because you have ample time and energy to take on risks, pursue higher returns, and accumulate more capital for retirement. Even if investments incur losses, you have the opportunity to offset them with earned income. However, once you enter retirement, the entire logic of financial management undergoes a complete reversal. The core focus shifts from growth to preservation, and from pursuing returns to ensuring security. For retirees, once your wealth reaches a certain threshold, enough to comfortably cover your retirement needs, or even leaving you with surplus funds, the core of financial management is no longer chasing high returns, but safeguarding the wealth you've already built. You know that no matter how the market fluctuates, you've already won the retirement race. There's no need to take on unnecessary risks. For the sake of extra gains, the costs would far outweigh the benefits. After all, the essence of retirement is to enjoy a peaceful and comfortable life, not to continue gambling in the investment market. If losses occur due to risky investments, they will affect the quality of your retirement and may even plunge you into financial difficulties, a situation where the costs far outweigh the benefits. Therefore, for every retiree, the most critical question is not, how much risk can I take on? But, how much risk do I actually need to take on? For retirees with very stable investment portfolios and a significant excess capital, the answer is likely this: there is no need to take on too much risk. Safeguarding existing wealth is the best financial choice. They can appropriately reduce the allocation of high-risk assets and increase that of low-risk assets to ensure the safety and stability of their funds. At the same time, by planning their spending wisely, they can enjoy the pleasures of retirement while protecting their wealth, achieving a balance between wealth and life. After all, the core meaning of retirement is to enjoy the leisure and freedom of one's golden years, spending time with family and savoring life, rather than continuing to gamble in the investment markets. By assessing one's asset base, rationally managing risk, and maintaining a stable standard of living without blindly chasing excessive returns or recklessly taking on unnecessary risks, one makes the most pragmatic and reasonable financial choice during retirement. This is also the best reward for a lifetime of hard work. Many retirees are able to enjoy their golden years precisely because they have grasped at this principle, shifted their financial mindset in a timely manner, prioritized the safety of their wealth, and avoided unnecessary risks. Many people fall into pitfalls in retirement financial planning because they fail to adjust their investment mindset in time, continuing to use the aggressive investment strategies they employed while working under the belief that the more wealth one has, the higher the risk one should take and the greater the returns one should pursue. This mindset overlooks the fundamental shift in core needs during retirement, ultimately exposing hard-earned wealth to unnecessary risks and potentially compromising the quality of life in retirement. In reality, the essence of retirement financial planning has never been about earning more money, but rather about preserving what you already have, ensuring that your later years are free from financial worries and that you can live out your remaining years in peace and stability. This is the core objective of all retirement financial planning. Let's revisit 3 case studies of retirees across different wealth brackets to further illustrate this point. A $1 million portfolio relies on high-risk investments to generate asset growth just to barely sustain retirement living, with market fluctuations directly determining the success or failure of the retirement plan. A $3 million portfolio achieves a balance between risk and stability, no longer overly dependent on market performance, significantly increasing the likelihood of a successful retirement plan. Even if the market fluctuates, it will not affect the basic quality of life. A $5 million portfolio has already achieved financial surplus. Low-risk investments are sufficient to ensure a secure retirement, with market fluctuations having a negligible impact. Retirees can completely break free from market constraints and enjoy life with peace of mind. These 3 tiers essentially represent a shift in the logic of retirement planning from pursuing growth to pursuing stability, from relying on the market to detaching from the market, and from risk-taking speculation to secure preservation. This shift is also the key to successful retirement planning. Furthermore, we must note that the existence of a retirement spending gap further reduces the risk appetite of affluent retirees, since their actual spending is far below their spending capacity. They do not need to rely on high-risk investments to bridge the funding gap, and thus have no need to assume additional risk. This rational spending habit not only allows their wealth to continue accumulating, but also makes their retirement life more stable and carefree, free from excessive anxiety over financial issues. For example, consider a retiree with a $5 million investment portfolio who has the capacity to spend $250,000 annually, but actually spends only $100,000. This spending gap means they do not need to pursue high investment returns. Instead, by adopting a low-risk investment strategy, they can ensure the preservation of their wealth and a stable lifestyle, while also achieving sustained wealth growth. We can further illustrate this principle by examining the actual circumstances of retirees in Australia. In Australia, many high-net-worth retirees share similar financial habits. After retirement, they gradually reduce their allocation to equity assets such as stocks and increase their holdings of low-risk assets like bonds, cash, and real estate investment trusts, REITs, prioritizing asset stability and reliable income. Australian retirement financial research also indicates that for retirees with investment portfolios exceeding AUD 3 million, keeping the allocation of equity assets below 30% can effectively reduce risk while ensuring sufficient income to support retirement living, a finding that is fully consistent with our previous analysis. This approach to wealth management not only safeguards existing wealth, but also ensures the quality of retirement life, making it a highly pragmatic and reasonable choice. Finally, it is important to emphasize that there is no one-size-fits-all standard for retirement planning. Since everyone's wealth level, spending needs, and risk tolerance differ, investment portfolios should be tailored to the individual and adjusted flexibly. However, regardless of your wealth level, you must remember one core principle. When investing during retirement, safety always takes precedence over returns. Once you have accumulated sufficient wealth to support your retirement, consider reducing risk appropriately and letting go of the obsession with high returns. Instead, take the time to fully enjoy the fruits of your hard work. By safeguarding your wealth while embracing the joys of retirement, you can achieve a balance between financial security and quality of life. After all, the true meaning of retirement lies not in the amount of wealth you possess, but in the ability to live each day with peace of mind and happiness, which is ultimately the very purpose for which we strive to accumulate wealth.